It will, and in large part it's a response to the inventory crunch and rising prices. The Fed is acting because prices in housing have just gone through the roof. Prices in other assets could follow. And so now you're seeing buyers really step back. For someone buying a $300,000 home, this is an extra $200 a month in mortgage payments. So it's a real bite.
Glenn, have you actually seen that in terms of activity through Redfin?
We've seen it in activity on Redfin's website. We've seen it in activity through our brokerage. We've seen it across the board in the industry. There's no question that some people who thought they could afford a house are now questioning whether they can. Some people who had decided to buy instead of rent are now looking again at that equation because there is more rental inventory now reaching the market, especially in major coastal cities. And so folks are shifting back toward rentals because the monthly payment is going to be lower there. And for the past few years, it's actually been going in the other direction.
Steve, Redfin's survey shows that fewer than half of the people said that they would either cancel their plan to buy a home because of rising interest rates or really slow down. But is that true? I mean, how do rising interest rates really affect the potential homeowners, home buyers, and how does that filter through the rest of the economy as people slow down home equity loans and refinancings and things like that?
So I think on a day in a week when rates are up as much as they are, we tend to think that that's the sole decision or the sole factor that cements the decision on the part of somebody is the interest rate. In truth, there's so much more going on in people's lives. There's their job, there's their salary. Do they have kids? Are they ready to move? Have they been planning to move? Do they need to move out of the city? All kinds of personal stuff that goes on. And the interest rate becomes a decision inside of all those other factors or part of those factors, but it's not often the most decisive thing. I get that it can be a lot of money. At the lower end, as you move up, it becomes less important. But the thing that people forget is we just focus as we have on rising interest and the added cost is the other side of the equation. You're doing 150, 200,000 people each month additional have jobs. You have salaries going up 2.5% to 3%. There's a bit of a sticker shock on the interest rate right now, but I don't think it's the decisive factor when it comes to either the housing market or the economy.
Yeah, Steve,
and I would agree with that.
Go ahead.
Oh, go ahead.
Go ahead, Glenn.
I was just going to say that we really aren't going to know what's happening in housing until 2019 starts. If the stock market is roaring, if the economy is strong, if wages continue to rise, there's no way the housing market doesn't shake this off. But I think it's fair to say that for the first time in 6 years, we are going into a new year with major questions about whether the market is going to go up or down in terms of sales volume at the very least. And so that's why everyone is having this conversation now.